So here we are on lucky Friday the 13th. Good news today for our subscribers that are still holding gold and silver. And I know there's a lot of you out there. You know I'm bearish. We see one more downturn in gold and commodities before this major correction crash is over. But gold has held better than any other commodity. So, you also know that my downside targets have gone to 700, say most likely, but also worst case, or slight new lows around 950 to 1,000. So that's a big change. It used to be 400 to 700. Now, when I was in Australia, I met with Naomi San Martin. She's one of our subscribers there. She is a trader. But she also really seems to get our long-term stuff. So I was talking to her and having lunch, and he said, you really got to check out this Slim guy. So he is a technical analyst for traders like her at AskSlim.com. And so I started checking him out. I subscribed to his service to check it out. And he's recently done a report on gold and silver miners. And what he was saying, now first of all, he describes himself as in the probabilistic world, which is exactly what I say. Short-term trends are probabilistic. There's no two ways around it. There's no way to have one clear scenario in the short term because it's so complex and politics matter so much more than the long term with fewer key indicators, and the politics averages out and all this stuff and wars and everything else. But he's saying he's seeing a high probability signal that gold and silver are bottoming here, just in a correction on his cycles, and he uses a combination of very good cycles, which I like, and of course normal technical analysis of support levels and waves and all this sort of stuff. He's seeing a high probability, like 80% plus instead of the normal 60 to 70%. And in short-term trading, if you're just 60 to 70% right, like Adam O'Dell, and you learn to cut your losses short and let your winners run long, you can kill it. There's nothing even approaching 100%. But he's saying this looks more than that. Support levels, cycles, wave patterns, everything lining up. And so he sees gold and silver moving up, particularly in the next few months, but his combination of cycles suggests it's going to go into the fall of 2020. Now that's interesting. He also sees long-term treasury bond rates going up from, say, 1.7 to 1.8 recently to 2% plus over the coming months, and he thinks stocks could start to peak as early as January, February, have a substantial correction, maybe retest later in 2020, 21, and then have the big crash. So we're really not that far out of line, but he's more focused in the short term, and that's what I'm interested in. His target for gold is $17.20. Silver like $21, maybe $22. So these are substantial moves. They're not new highs. I'm not expecting new highs. He's looking at $17.20 likely target, and as high as $1900 if the Fed goes nuts and start printing too much money and stuff. So that's a substantial move, and it would be consistent with gold rallying in the late stages with some inflation, and even more so if the economy starts weakening in the early stages of a downturn. They smell the money printing. Gold and silver smells that, so will Bitcoin and cryptocurrencies if it happens. So this could be late stage inflation causing this. It also could be some weakness in the economy that wakes the Fed up and they start doing what Trump's been saying, and then that plays into my megaphone pattern where stocks could peak near term, correct a good bit, and then have one final rise to new highs into 2020. But again, what I like is Slim is saying high probability. He's the most clear about gold and silver right now, and he's saying the smart money, which would buy the more beaten down and more highly leveraged gold and silver miners, they're already moving ahead of the moves that are just starting in gold and silver. So again, we could see a scenario, gold goes up at least into February, but could go more. And this could happen while stocks top and start to go down, just like in 2008. In October 2007, stocks top, but gold kept going up into June of 2008. So he's looking at potential February top in stocks, give or take, and then a retest later down the line and gold not topping until late 2007. So these are things we're going to continue to monitor. But hey, you got gold and silver, hold it. But we start hitting these 70. My targets have been 1700 to 1800. Retest of the highs 1934 tops, but I do not expect that. I do see this as a bear market rally. But if we start to get in those levels, 1720, 1800 or whatever, don't look a gift horse in the mouth. Now we'll relook at this when we get there, but if we do get this breakup where there's high probabilities here, then that's a real selling opportunity. Same thing on the opposite side. If treasury bond yields do start to go up, if gold's going up, and those could go in tandem with higher inflation or maybe money printing and stuff, that sort of thing. Okay, if the 10-year gets 2% or higher and the 30-year gets to 2.4, 2.5, 2.6, that could be a good entry point to get out of stocks and into the most safe haven long-term treasury and AAA corporate bonds, that deflation play. There's been a first one in the last year, which normally wouldn't occur while stocks are still going up, but this is going to be the bigger one, where we could go from, say, a 2.5% 30-year treasury bond down to 1% or lower. That's a big capital appreciation play. You're getting a yield like a good dividend stock. So you're making money while everything else is crashing. And again, gold should normally hold up in the earlier stages as safe haven until gold starts to see deflation, and then it runs to mommy like it did in mid to late 2008. So just an update. We'll look at this more in the future. And note, in the January boom and bust, I'm going to be talking about money velocity around the world. We've always talked about it in the U.S., productive investment, big indicator from Dr. Lacey Hunt, one of our featured speakers, always at IES. But here we look at it around the world, and it's more important in emerging countries because they're investing the most money. And if it's productive or not makes a huge difference. And guess who's the least? China, of course. But I'm also going to give a clear 2-page update this scenario in stocks where we could have a breakout, and that is now looking more likely with this scenario and just with recent activity on Thursday. The S&P is right at the breakout level. We said it's not about new highs, it's about breaking above this megaphone pattern enough to be convincing. Dow's not quite there yet, 28,500. A break above that would be more clear. And the NASDAQ, of course, is moving, and it's not in this megaphone pattern. So we could have this blow off top into early 2020. That's still scenario one, and looked a little less likely months ago. Now looks more, especially if we get a trade deal, which Trump's talking about, but he's always suggesting this. Or we could get this bigger correction in stocks on the megaphone, and then this final rally where the NASDAQ makes new highs and the broader indices, S&P and Dow, don't. Major divergence. So those are still in play. But again, the clearest trend right now, gold and silver look up. Hold on to that stuff, but again, don't look a gift horse in the mouth. If we get that close to the old highs and you sell out and then you rebuy in because it breaks right through them, you haven't lost much. But the downside will be way, way more compelling at that point. You got to listen to me on this. So we'll keep you updated and look for that January boom and bust coming out pretty soon.